Hey guys, some traders use a one-to-one risk-to-reward ratio system, which is fine. It allows you to build up your confidence faster, and since trading is a psychological game, confidence is very important. However, some traders prefer to wait for the perfect opportunities to enter positions with high risk-to-reward ratios. This video will explain how to take single and multiple targets using any strategy. Also, I'm going to teach you a tracking technique that allows you to catch insane risk-to-reward ratio trades. So if that sounds good, as always, make sure to hit the like button to show your support and subscribe to our channel if you're new since we publish advanced trading knowledge. Now your profitability in trading will be determined by your win rate and risk-to-reward ratio. The win rate is the percentage of wins you have. For example, if you win 5 out of your 10 trades, then your win rate is 50%. Most traders focus on finding a trading system with an extremely high win rate because they believe it is required to be profitable, but it is wrong. Risk-to-reward ratio plays an important role in profitability as well. Now, what is the risk-to-reward ratio? The risk-reward ratio is used in trading to assess the potential return on the amount of taken risk. For example, if your stop loss is 10 pips and your target is 30, you have 1 to 3 risk to reward on the trade. So basically, if you're willing to risk 3% of your capital on this trade, you will gain 9% if you win. Trading plans with a lower risk to reward ratio have higher win rates and are mentally suitable for novice traders. However, plans with a higher risk to reward ratio allow traders to let the profits run and gain maximum profits from market swings. Now let's continue and discuss some of the best profit-taking strategies traders have developed over time. These techniques primarily aim to generate more profits and avoid a winning trade becoming a losing. There are 2 different strategies that we are going to explain: taking multiple targets and tracking technique. Let's start with the first one, taking multiple targets. This technique consists of 2 targets. In the first step, we will make our trade break even and let the profits run until we reach our second target. Imagine, after seeing this bullish engulfing candlestick pattern, you have opened a long position on this pair, predicting the price to rise. You have put your stop below this candle, which makes it 20 pips stop. Now, what would happen if we set our first target at a 1-to-1 risk-to-reward ratio and close half of our position when the price reaches there? We will have a winning trade with half position and 20 pips target. So, even if the price returns and hits our stop loss, we won't lose any money. This is the best way to secure our profits and avoid a winning trade to end up losing. There are 2 ways to execute this technique in your trading platform. You can close half your position when the price reaches your first target, or open 2 separate positions. These 2 positions will have half of your initial position on this trade. For example, if you're willing to risk 2% of your capital on this trade, you must open 2 positions with a 1% risk. Set the 1-to-1 target for the first position and your higher time frame target for the second one. This will give you a total of 2% risk, and you're going to have 2 separate positions open, and you can take multiple targets. For the second target, you can choose a fixed amount like 1 to 2 or 1 to 3 R to R, but we prefer to check the higher time frame key levels and set our second target at these areas. For example, if we zoom out to the 4-hour chart, we can see that this area has acted as strong resistance in the past. Look at all these rejections. So, once again, if the price returns to this key level, we can expect a reaction, which would make our higher time frame target for the trades. Since a small reaction to a higher time frame key level can be a major reversal in the lower ones. Now, you could also add another simple strategy to secure some of your profits when price hits your 1-to-1 target. You can reposition the stop loss of the second trade and put it at the break-even point. For example, you're going to have a situation like this. Your first position is going to hit the first 1-to-1 target. So, we're no longer going to have that, and we're going to reposition the stop loss of the second trade and put it at the break-even point. So, in the worst-case scenario, you will still keep the profits of the first winning trade. Now, this was the first taking profit technique, which is a great way to set our targets and manage open positions. Still, another considerable strategy allows us to get insane risk-to-reward ratio trades without experiencing much trading tension. This technique, if the price goes along with our predictions after entering the market, we let the profits run and reposition our stop loss below the latest structure. Let me show you an example. Here, we have a bullish market. The price has rejected the 50 EMA with an engulfing candlestick, which is our entry reason to go long. Now this is our entry and our stop loss. In this technique, we let the profits run, but every time the price breaks a structure to the upside, we will reposition our stop below the latest swing low. This way, on one hand, we secure the profits we got by repositioning the stop, because if the price reverses and hits our stop, we would have a winning trade. This will remove all the negative psychological aspects of trading since we know we have already won the trade. On the other hand, sometimes this technique results in massive profits while risking the same amount. For example, here we have a break of structure. So, let's reposition our stop loss below this swing low. This way, even if the price reverses, we can still catch some of our profits, and we won't lose anything. But in case of continuation, we can catch a more significant number of profits without the fear of losing money. Let's continue and see what will happen. Here, the price has broken above the structure level. So let's reposition our stop below the swing low. But remember, you have to give room for the price to breathe in case of the deep retracement. So, don't attach your stop to the bottom of the candles. Now, this process continues until we reach a higher time frame resistance area where we can finally close all of our positions. Or, in case of any sudden reversals, the market will hit our stop loss, but we will gain profits. The first main advantage of this tracking strategy is that usually we will be at more than break even through the first repositioning, so it will completely remove the stress of outcome during the trading. The second advantage is that sometimes it leads to a massive risk-to-reward ratio, which allows you to grow your account faster. This type of managing open positions could be highly beneficial for a full-time trader like us that have time to sit behind the computer as many hours as necessary depending on the trades we're in and need to manage. But if you're someone who currently has a job that keeps you away from the computer and being able to manage open positions, then this may not be the best for you. However, all traders should be aware of these types of trading techniques. You could utilize this profit-taking technique using any strategy. But, as always, before using any of these, you should open the chart of the assets you're trading and backtest it to see which one works for you. We use the TraderEdge platform for backtesting our exclusive trading strategies. If you're interested in using TraderEdge as your backtesting tool, be sure to check out the link in the description below. Now, as always, let's open the TradingView platform and backtest these techniques on the real chart to show you what goes through our minds when trading opportunities arise. We will use the pullback trading strategy we have shown you previously, in combination with taking multiple targets and tracking techniques as our managing strategies. If you want to learn this trading strategy or have doubts about the rules, I'll put the video link in the description. Now here we have the pound dollar on the 1 hours chart. Let's apply the exponential moving average on the chart and set the input amount to 50. Here, we can see that the price has broken the 50 EMA to the downside and created a new low, so we have a bearish bias and want to trade with the dominant downtrend. Now all we need to enter the short position is an advanced bearish engulfing candlestick pattern. But first, let's check the higher time frame and see the bigger picture. Here on the 4-hour chart, we can see that we have a strong demand area with multiple rejections in front of the price. So, there is a high chance that the price will bounce from this level again. But we still have room before tapping into this area. So, the higher time frame confirms that we can take short entries, and our long-term target would be this level. Let's get back to the 1 hours chart. Now, the only thing we need in this time frame is an advanced bearish engulfing candlestick to enter a short position. Here, we have our second trading model. The price has rejected the 50 EMA by these candles and printed an engulfing candlestick pattern, which is our entry reason to go short. Now let's open 2 positions, each with half the amount we want to risk in this trade. The first one would have a 1-to-1 risk-to-reward ratio, and the second would target the higher time frame key level. Let's see what happens. Right now, the price has hit our first target, so we have one winning trade with 1-to-1 R to R, but the second one is still running. Now, if you would like to secure these profits, you could move the stop loss of the second trade at the break-even point. However, we prefer not to change it because the market usually has many fluctuations before reaching higher time frame key levels, and the safest place to stop is above this swing high. Also, even if the price reverses and hits our stop, we would still be at break-even because we have won the first trade. Now, let's see another example. Here we have Dow Jones in the 30-minute time frame. The market has broken above the 50 EMA and created a new high. So we have a bullish bias. The price has rejected the 50 EMA with a bullish engulfing candlestick pattern, which is our entry reason. So let's open a long position and use tracking profits technique for this trading setup. But first, let's check the higher time frame and set a long-term target. Here on the 4 hours chart, we can see that the market has recently rejected this area of demand. Now, our long-term target would be this supply area, which has previously acted as a turning point twice, so we still have a lot of space before reaching it. Now let's get back to the 30 minutes chart. Let's open a long position, set the stop below the engulfing candle, and track our profits if price goes higher. This means that every time the market breaks a structure level, we will reposition our stop below the latest swing low. So, if we use this horizontal red line as our stop loss, it will look like this. This process continues until the price returns and hits our stop loss or reaches our higher time frame target. The tracking strategy can sometimes lead to a massive profit. However, you must backtest it with your trading plan to obtain the performance for yourself. So guys, that's it for this video. I hope this video provided value to you. If it did, please go ahead and smash the like button to show your support. And if you're new here, consider subscribing to our channel. See you in the next episode.